And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, strategic alternatives, and business development, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of, is the venture model a bust in healthcare? So Sam, I'm hearing audio feedback.
You are.
Can you check? Apologies to our audience.
Okay. I'm just going to remove the LinkedIn thing. That feels like
great. Yeah.
That's
our show today is on the topic of, is the venture model a bust in healthcare? The boom of digital health venture funding has not produced the returns investors hoped. What's next? Our guest today is Sam Toole. Sam is a partner at Primary Venture Partners, an early-stage venture fund. Sam focuses exclusively on early-stage healthcare investing. You can follow him on x.com at SamDToole. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love seeing reviews. We have a new podcast links for the shows, so make sure that you see recent episodes when you subscribe, or you could be on the old links, old page, old podcast, and you won't get new episodes. This show is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Sam and I will spend the first half talking about the news and the macro picture and some other topics. And then for the second half, we'll focus on our special topic of the day. And we'll be taking your questions throughout from the LinkedIn chat. So hello, everyone. I see Jean-Luc is already in the LinkedIn chat. That's great. So Sam, please introduce yourself to our audience.
Yeah, and Stephen, appreciate the chance to be on the podcast and getting the chance to chat. Quickly on my end, I'm a partner at Primary, as Stephen mentioned. I've been in the world of tech for about 15 years. The first 10 years of that was as an entrepreneur and operator. I started a couple non-venture scale businesses and ran those. I like to joke I learned more about what not to do during those years than what actually to do, and then held different sales and go-to-market positions in a handful of different venture-backed businesses, a big chunk of that in the world of healthcare. I came over to Primary about 4.5 years ago, where we do early stage seed investing, and I spend all my time doing early stage healthcare investing with the core belief that to be a great healthcare investor, you need to be able to get really deep and deeply understand markets and incentive structures and all of the things that don't make sense in healthcare when you start to peel that onion back. So excited to be here and chat all things healthcare and venture.
That's great. Thank you. And I'll note also that if you were to cycle back 5 years ago, I think people would have said that the healthcare innovation scene in Boston was much stronger than in New York. And there was a question as to whether New York could catch up. It certainly had the bones to do it. It had the research facilities and the investors. And now in those 5 years, when you've been at Primary, New York has I would say equaled Boston in terms of the vigorousness of the scene, the amount of funding. Bunny Ellerin with her group like New York Digital Health has been chronicling this pretty well.
Yeah, I think the general startup scene in New York has really exploded. The Primary was actually started in 2015 with the belief that New York was going to be the tech hub of the East Coast and was going to be really only second to Silicon Valley from a deal formation perspective. If you look at that, if you fast forward to today, if you actually just look at early stage company formation, New York is now at about 80% of Silicon Valley from a new company formation on the seed side. So we've just seen an absolute explosion. And on the healthcare side, a lot of my venture friends who do West Coast, live on the West Coast, are here in New York every couple of weeks because their portfolio companies are here. They're looking at new deals. So the general scene has exploded, but healthcare in particular, it feels like New York is the place to be. And I'm a Massachusetts guy, so I love Boston. So nothing against Boston. I'm a big fan. But
And I see in our audience, we have Alex Fair of MedStarter. So when it comes to nurturing the very early stage, the seed stage, and then the early stage scene, MedStarter, has been, nurturing the community for a long time. So, and thanks for coming, Alex. So let's see, moving on to macro news, the question I get asked the most from the innovation economy, the young companies, and the investors who back them is, when will the fundraising environment get better? And a lot of this seems to be dependent on the macro environment, so we have to learn about the macro environment. And I'd say the last couple of weeks were defined by Fed waffling on rate cuts, which is bad news. We want the Fed to be clear, to make predictions of its own behavior and then follow them, not to seem to be backtreading or crawfishing on anything. And so I think what's happened is the Fed was scared by an inflation print from March. And ever since then, the Fed chairman has been waffling on, will we see 3 rate cuts of 25 basis points by the end of the year? And regardless, any rate cuts seem to have been pushed off a few months. And Larry Summers did the unthinkable and sort of raised the topic that we might see rate hikes, because he's being an inflation hawk. He wants to tackle inflation first and foremost, get that done. That would be bad news for the innovation economy. And in my opinion, the innovation economy wants to see rates flat and down. That's that. But I'm also hearing that fundraising is hot for top tier digital health firms. So if you have outstanding characteristics like a repeat CEO who's made money for investors, or extremely strong product market fit, product flying off the shelves in terms of sales, high margins, that sort of thing, action is back, high valuations are back. And I've heard this for the last month, and I'm calling this digital health fundraising spring after 2 years of winter. So, Sam, any thoughts on the Fed, and also on, we're not seeing it in terms of macro numbers, we're seeing it in terms of elite deals, I would say, the
Sure.
spring.
Yeah, so clearly the ZERP era was a huge driver of a lot of venture investing and lofty valuations a few years ago. We saw a bit of a winter, but I think there was a JP Morgan report that I saw maybe a month ago, looking at the public market and the realities of the public market starting to become decoupled with the fundamentals again. So despite interest rates rising, you're seeing companies getting valued in a way that is starting to shift from a sort of core fundamentals perspective. If you look back, multiple decades, I think we're seeing that in the private markets as well. And I can share a bit of perspective. I think from a seed stage side of things, even as there was a winter on the growth side, early stage seed businesses over the last couple of years, even as the private markets cooled down, continued to raise at lofty valuations. If you were a great founder building an interesting business, you were able to go out and raise $6 to $8 million off of a deck and sell 20% of your business, or 25% of your business. The growth market, that was certainly not the case, but we've seen it across healthcare, fintech, software infrastructure, vertical SaaS, that over the last quarter, that started to change. And people are saying, I need to deploy capital. We're seeing interesting businesses that are coming back to market that look great, are growing quickly, and we are going to look to win those deals. Of course, what's happening is that a lot of people are trying to win the exact same deals. So that's driving up prices even further. And so we've seen a real shift, and that's both across our portfolio and then with a bunch of my, friends and colleagues who do that from a full-time basis.
So you say you've seen a shift. Is that right now, last couple of weeks, months, or
the last quarter? And this is like, I have colleagues who in 2022, their firm invested in 1 deal. In 2023, they invested in 2 deals. In 2024, they've invested in 6 deals. And these are large growth funds. And I think you're seeing a lot of companies coming back to market who may have been very well capitalized a few years ago, didn't have to go to the public market or to the private markets for a good chunk of time, but are now saying things are starting to open back up. We have an opportunity to raise capital at great terms, and we're going to take advantage of that. It's still that top quartile of businesses, I think, but there's been a shift for sure.
So that's great to hear from you. And yeah, I'm calling this the first major shift in 2 years for the digital health community, which has found fundraising to be very tough for 2 years. So for sort of for top tier deals, they're seeing the VCs used to be sort of the CEOs are swimming in the pool. The VCs are on the bleachers saying there's too much uncertainty. Now we're seeing for top tier deals, VCs are jumping in the pool. So
yeah, I think on the healthcare side, the question will be, how do some more of the tech-enabled services businesses ultimately get valued? And I think where there will be challenges is if you were top ticked in 2021 and someone was valuing you like a software business, but you're a tech-enabled service business, what does that valuation look like? I think there's still some big unknown questions there, but we'll learn a lot in the next 6 to 12 months.
Very interesting. And for our audience, by the way, you're welcome to to throw in comments. We're talking about macro news right now, but now we're going to shift on to industry reports. So, did any reports come out? I didn't see any reports come out in the last week or two that would matter to my audience. Does our audience know of any reports? You can put them in the chat. Sam, did you see any reports in the last 2 weeks that's worth bringing to our audience?
Nothing that jumped out to me. I think some of the macro news and then some of just the news and the trade journal stuff was probably where we were spending more time, to be honest. Mm-hmm. We were also sprinting at a couple deals, though. So in those moments, I'm hyper-focused on those companies.
So then, and I don't see any reports mentioned by our audience. So then moving on to the next topic is trade journal news, business news. So, and I like to focus on fundraisers here, and we're still in a time of more wind downs than fundraisers, which is sad to see in the sector. But the first news I'll bring is, so I didn't see a lot of classic fundraisers the last 2 weeks. Mm-hmm. That's too bad. I'm always looking for classic fundraisers where U.S. digital health venture funds back, high potential young digital health companies. Didn't see a lot of those. One interesting one is that Michigan-based Blackwell Security. It's a cybersecurity firm for health systems. I haven't seen that before. Usually, when you think cybersecurity, you think generally excellent cybersecurity firms that would apply to healthcare as well. And in general, healthcare spends less on cybersecurity than corporate America, so it's not a very attractive market. It's not the first on their list for the cybersecurity firms to go after. It does have unique challenges. You can really cripple a provider business, and you can cause unending worry and pain for patients and others by hacking a health system. So Blackwell Security raised $13 million in a syndicate led by General Catalyst and Rally Ventures. So that's interesting to see General Catalyst, leading this. You don't see a lot of cybersecurity and healthcare deals. They named their first CEO, Geyer Jones, and the company is part of GC Hatch, which is an incubator from General Catalyst. And most of us here know that cybersecurity is in the news because a few months ago there was a successful cyber attack on Change Healthcare, which is a part of Optum. That was a nightmare, and that led to thousands and thousands of providers not getting paid for weeks with real expenses out the door and their revenue not coming in the door. That was a huge problem for providers. And so cybersecurity is in the news. So what do I like to try to generalize what I learned from this. So the first is this could be an intriguing category, cybersecurity for healthcare. And the second is VC firms with incubators. You probably have a lead for your first round, I would bet, if you're coming out of a VC's own incubator. And then what I'll do is I'll go through two, and then I'll get your reaction, Sam. So the next was a product announcement. And so here, the FDA approved Apple Watch's heart monitoring tool for atrial fibrillation for use in clinical trials through the FDA's Medical Device Development Tools Program. So it can be used in clinical trials, making it the first digital health tool to be qualified under the MDDT program. So this is interesting. Not as big a deal as if they had approved it for, say, monitoring atrial fibrillation in patients, but they're approving it for clinical trial subjects. And then relatedly, in February, Apple won a court battle against AliveCor. AliveCor had sued them over claims they were monopolizing the US market for heart rate monitoring apps and infringing on AliveCor's IP. So that's interesting. I always interested to see what Apple's doing. Clearly, Apple would like to be more in healthcare, get their Apple Watch certified for use in more use cases. So, Sam, any thoughts on these?
Yeah, I think starting with the first business, Blackwell Security, I think clearly change brought cybersecurity to the forefront for everyone. And as we've spoken to large provider organizations, payers, startups, no one's going to be single threaded today across anything that has to do with money moving. And I was in a board meeting before, and right before this, and someone was talking about one of their clients not being able to get paid for multiple months because of this. So I think this is a category that a lot of people are spending time and thinking about. When we've looked at it in the past, the question we've had is, does it make sense for there to be a vertical solution or a horizontal solution? Is the best-in-class cyber business ultimately going to be something that can serve a lot of different industries, or do you need something that is very healthcare focused? GC brings a unique ability, especially with their acquisition of Summa, the health system in Ohio, to potentially plug in and start to work in a deeper way with someone like Blackwell, although I'm not sure that is their first customer. So I wouldn't be surprised to see more on the cyber side, but I would have the sort of broader theoretical question of horizontal versus vertical. In terms of the Apple Watch announcement, I mean, this is great to see. I think we are in the earliest innings from a medical device and AI and how we all integrate and how data gets flowed back and forth to providers and how we're living our sort of day to day. There's still clearly a lot of big questions around how do these types of things get reimbursed for, and as you think out and you sort of think about Apple becoming more of a medical device, but giving a consumer more power to sort of understand their own health is just, I think, a huge positive. And so they're well positioned to do that. It's Apple. Like I have an Apple, like I have every Apple device, everything's Apple. Like there's a lot of reasons why they should win here.
So I remember when Fitbit came out with its heart rate monitor, and it adopted a convention that other people have adopted since, which is that it says it's a consumer grade device, and then they do not seek to make a diagnosis or claim clinical grade for their monitoring or anything like that. And others, including Apple, have followed suit since then. But what's interesting is that sometimes the consumer grade devices, they tend to be more decentralized. They tend to be lower cost. They tend to have different modalities for generating data than clinical ones, and so they can definitely be inferior to clinical products. And I'm glad there's this distinction here. But sometimes they can actually be just as good as clinic grade FDA cleared products. And so an interesting example of this is with heart rate variation as measured by our activity trackers. They can actually detect if you have a serious heart problem, and they can't tell you. And so the language I've seen them use,
which is crazy when you think about that.
Yeah.
If you take a step back and think about what that actually means from a human level.
So what the convention they've adopted is they say anomaly detected, see your doctor. But they could tell you a lot more. They know a lot more. They just can't tell you because the device was a consumer grade device. So
yeah, we all know that Apple is spending a lot of money and time thinking about how they can continue to shift more into more of the medical device side.
Yeah. So the next story from the trades is that Weight Watchers announced its partnership with Personify Health. So Personify Health, that is, if you remember, Virgin Pulse merged with HealthComp in a $3 billion deal. To me, that deal's very significant because I think that sector, which is the sector that sells health tech into the employer market, is the sector of Accolade, Teladoc, and Castlight and others. That sector is ripe for consolidation. Hundreds of point solution companies in that sector, and the deal of Virgin Pulse and HealthComp merging was, to me, a starting gun of consolidation in that sector, overdue consolidation. So Weight Watchers announced a partnership with Personify Health to allow employers to offer the company's business solutions to employees to access weight-related healthcare offerings. These include programs for those with diabetes and for those who are on GLP-1 medications. So really interesting there. This is just the continuing reverberations in the pond of GLP-1. So GLP-1 is like a giant rock thrown into the pond of healthcare, and this is one of the ripples coming out of that. Is many companies have to rethink of themselves around GLP-1s, and including obviously in weight loss, but also in diabetes and other areas as well. And there are some employers who are saying, how do I get out of paying for GLP-1s? But there's other employers who are saying that the math could work for me. I could see a reduction in obesity and diabetes and chronic conditions if I pay for GLP-1s. So I find this very interesting. It's digital health companies trying to figure out how to adapt to GLP-1s in an employer context. So any thoughts on this announcement?
Yeah, I mean, I think it's just the continued trend towards, as you said, the explosion of GLP-1s and employers reacting to the fact that they need to figure out how to pay for this, or if they're going to pay for this, everyone is asking for it. And I think we still have a ton to learn in terms of all of the positive benefits and potentially negative benefits as well. But the early research is really encouraging as you think about other chronic diseases. So it's not a surprise. And I think it makes a ton of sense for a business like Weight Watchers to do a partnership like this, especially as you think about what the reimbursement pathways start to look like in terms of being able to prove that I am exercising, I am doing these other things, perhaps before I'm getting access to the drug, and I'm continuing to do that. So I think the combination of exercise plus the access to the medication makes a lot of sense. And I wouldn't be surprised if we see other partnerships like that.
Thanks. Yeah. And Zoe has asked a question about what are VCs looking for in digital health, and I'll save that for the second half of the show.
Happy to talk about that.
And then another announcement, Transcarent. So everybody's interested in Transcarent. Everyone wants to know what Glenn Tolman is up to. Glenn is probably the most successful serial entrepreneur in digital health. And so they just announced a big Series D fundraise. So Transcarent, a digital platform focused on self-insured employer market. So Glenn built Livongo, which was also focused on the self-insured employer market. They announced they'd secured a $126 million Series D investment, bringing the total raised to $450 million and the valuation to $2.2 billion. So this is one of the biggest unicorns, and it just had you would think that valuations would have come down a lot, but this is a company that has sustained its unicorn valuation through its next fundraise in the post ZERP era. So the round was led by General Catalyst and 7wire. Glenn, when he's not the CEO of a hot digital health company, he's a partner at 7wire. With participation from Memorial Hermann Health System. I haven't heard of Memorial Hermann Health System doing a lot of investments, so it's interesting that they're in this one. They're also a hospital, so I don't see what the employer market has to do with hospital corporate venture funds. and geodesic capital. I don't see them do a lot of investments in healthcare. I wonder what exact role they're playing as a follow-on investor here. Also, contributions from former investors, including Human Capital, Kinnevik. Kinnevik's an interesting Swedish investor, Threshold, Ally Bridge Group, Alta Partners, and more. So many of my friends don't know what Transcarent does, and these are the sharp observers. So everyone knows it's Glenn Tolman, his latest vehicle, and a lot of people don't know what it does. The article I read said that they are doing things like navigation and a pharmacy benefit product and that sort of thing. There's an irony, which is that the more we know about it, or the more that people know about the company, and maybe if it were to become profitable, suddenly it would have to face realistic valuation expectations. But if people don't understand it and it's not profitable, then they can coast along at high valuations without a lot of pressure. That's saying more about the market than it's saying about Transcarent. So I think you see that glimpse of what Transcarent does. So there's a lot to take from this. So one is that Glenn Tolman continues to be very good at raising money. The next is that I think that this is part of a consolidation and shakeup of the employer health tech sector. I think Glenn sees that there's problems with the large number of point solutions selling to employers, and that there's room for a platform to come along. And maybe he can't be in diabetes because of a non-compete when he sold Livongo to Teladoc, but he can be in other areas like pharmacy benefit and navigation. And so I think he's looking to shake up the sector that he was just in with Livongo. I think this also reflects that top companies are seen as kind of safe bets by investors. So investors can put a lot of money to work participating in a $126 million round, happy to do it, but they're doubting some of their investment theses, and they consider there's too much uncertainty in the markets, and so they're reluctant to go into more, to use their risk capital for riskier opportunities. So you see super rounds like this one. And I also think that this is a reflection, Glenn being in navigation, that's a reflection of what I would say, that navigation sounds unsexy as compared care management, like diabetes and hypertension, sounds sexy because those are such big problems, and navigation sounds unsexy because of the history of Castlight and because it's just helping employees figure out their way. But I actually think navigation is very, very strategic. So I think that Transcarent is exemplifying that by having a navigation concierge as part of their offerings. So that's what I take away from the news of Transcarent. Sam, any reaction to that?
Yeah, I think it's, if you're putting yourself in GC's shoes, you've backed Glenn beforehand. They incubated Livongo with him, although it ended up, they ended up making a lot of money. Although long term, it ended up being not great from an enterprise value perspective. So I think Glenn's a legend. It's an easy investment to make in a lot of ways, to say, if you believe there's going to be consolidation, which I think you're spot on there, who do you want to back to go and consolidate this very, very large commercial market that has an immense amount of point solutions? And although we're not investors in Transcarent, we didn't look in any of the rounds. Our understanding is a lot of the growth has come through M&A and them acquiring businesses and doing that. So my guess would be Glenn told a really compelling story around, this is my view of the world from a commercial population perspective, and back me to go out and execute on this vision. This is likely a indication as well of a decoupling of business fundamentals still from where the business is and the valuation. But when you have people like Glenn and that team, those are the true sort of venture investments that people like General Catalyst and others are excited to make.
Yeah, thanks. And Brad comments that that Apple brings an understanding of consumer engagement to healthcare. Brad, I couldn't agree more. Healthcare has been really plagued by products that have poor user design, poor consumer engagement. And Apple's magic touch seems to be that from an engineering perspective and a timing perspective and a design perspective. They seem to just get it right and get consumer buy-in to behavior change, for example. And then Melinda just mentions that, interestingly, GLP-1s may be a molecular drug, and that's what all the excitement is about. But if you're going to take them, you need to do strength training. You need to do that, and that's where digital health comes in, and that can be key. So thank you, Melinda, for that.
Yeah, that's why Weight Watchers, which from a public company perspective has not performed well. The combination of the two makes a lot of sense.
So next, I think the biggest story of the last 2 weeks is Walmart announcing the closing of clinics and virtual care. So this is a big disappointment to me. I think Walmart getting into this area was wonderful for patients and terrible for doctors, and also terrible for the innovation economy, but great for patients. It meant more access for patients and cheaper care for patients. And then surprisingly, and Walmart made a big push in 2019, many other firms have also made that big push, and doctors thought that their dinner was going to be stolen from them by Walmart and Walgreens and CVS and Amazon and others. And they said that the business model of offering primary care out of Walmart stores was unsustainable due to a challenging reimbursement environment. I'm not sure what exactly that means, what they're referring to. And escalation of operating costs. Well, that's very understandable. And so Walmart has always had pharmacies and vision centers, and they'll continue to have pharmacies and vision centers. I think this is bad for the patient. It's good for doctors. They no longer are being threatened by Darth Vader in this way. And it's good for innovators, because there's a little more breathing room now for innovators to come in and do things in primary care medical practices and not have to think that they're competing with Walmart down the street. So Sam, any thoughts on, and I think this was by far the biggest announcement of the last 2 weeks.
Yeah.
It had people buzzing. Any thoughts on why did Walmart fail? And does this mean that CVS and Walgreens and Amazon and other grocery chains that are doing this are going to fail?
It's definitely a huge disappointment. I think if you take a step back and think about it in the Walmart brand, and from a consumer perspective, consumers walk into a Walmart and assume they're going to get the lowest prices possible. Like, that is the whole Walmart shtick. As we both know, primary care as a standalone business from a fee-for-service perspective is really challenging from a reimbursement perspective, and thinking about that. So when you look at that, due to a challenging reimbursement environment, unlike if you were a hospital, Walmart doesn't have any ancillary services. You can't get sent to a specialist. You can't use primary care as a loss leader to build a relationship with a patient. So when you combine the pressures to have the lowest cost to a consumer with a business line that is unsustainable from a unit economics perspective on the primary care side, and their inability to then tie in other revenue streams to expand the LTV of a customer, kind of makes sense when you think about it from that end. And they, unlike some of the others in the market, did not lean into a capitated model and taking risk on a population and thinking about that. So it's a huge disappointment. It's pretty surprising given how innovative they've been with their own employer base, or at least historically that was the narrative. So I'll be curious. I mean, we've obviously seen a lot of other closures with, the Walgreens and CVS and some of the Village MD. Like that is, unfortunately, this is a trend that has started, and I don't think is going to stop. But if you go back to the consumer here, it's a real disappointment.
Yeah, thanks. And Brad points out that between Walmart closing down clinics and virtual care and what's happening in telehealth, it seems that the alternative on-ramps to the healthcare system are still trying to find a model that works with consumers. Yeah, Brad, that's right. And Walmart, I would have said they have all the advantages. They have people who are going to Walmart anyway for white goods, for food, for pharmacy, for vision, and then they can build off of someone gets a medical appointment. They say come back in 15 minutes, and that person shops for 15 minutes. So thanks, Brad. And then so Audrey asks, do you have any comments on the newly formed Wonder Woman Collective aiming at tackling gaps in care? So that's a really good question. I'm not very familiar with this, but we're measuring healthcare more than ever before. And so there's never been a better time to be able to spot gaps in care. And what gets measured gets done, and gaps that get brought to the attention of clinicians can be addressed. And usually the system will pay for qualified care where it's brought to their attention that there's a gap in care. So I like the sound of that. Let's see. So Fahad mentions that Walmart was launching Medicare Advantage plans with United Health. There's been a retrenchment in Medicare Advantage as well that coincides with their departure from primary care. Yes, I wonder what will that ultimately will that
my understanding is that team is likely not sticking around on the Walmart healthcare side, at least sort of the rumblings that we've heard. And yeah, they had some promising deals in the United end, but I think from some of the conversations we had with people there, like, again, the unit economics were challenged, and they didn't get credit for bringing Sam into the store, and then Sam bought a bunch of stuff and that being valuable, or vice versa. So it was really viewed as a standalone business unit.
That's interesting. So, healthcare not being able to stand on its own, but being evaluated by what it brings to the rest of the store. So, so let's see. We'll move on to what I call the inflection points part of the show. So here's where we talk about inflection points, which is trends in the market, the innovation economy, entrepreneurs. They want to follow inflection points, ideally get on an inflection point that's going to happen before it tips, and then ride that tipping to your future. So I'll mention here, and so we sort of talk about an inflection point and whether we're before the tipping point or after the tipping point. One, I'll say asynchronous care. I think this is really interesting. This has, young people expect care to come out of their phone, and young people, totally accept texting. And so I think asynchronous care for regular health care, or for that matter, maybe for mental health care, has a lot of potential. And I think it's still with just early adopters, and it hasn't yet hit the major inflection point yet. So I would look to see, for our entrepreneurs in the audience, I think asynchronous care is a really interesting opportunity to find the audience that wants asynchronous care and sell it to them, because there's going to be an audience that gets great healthcare now and rejects that. So that's one. What do you think, Sam? And do you have an inflection point you want to call out to our audience?
Yeah, I'd say on the asynchronous care side, I think I would tend to agree. We're still early with that. We've seen Row and Hims and businesses like that employ that relatively well. Another, I'd say, inflection point or a place where we're early is the adoption of AI and large language models and Gen AI. I think we are in the earliest stages of that still. We've spent a lot of time talking to health systems, providers, to understand how they're using this technology. Most of that has been on the back office or in the back office today. We see a lot of businesses who are going out and starting to build here, and I think we're still very early. And then if you think about how that gets applied to the clinical side of the house, even earlier on that end.
Great. So Brad asks us, why is so much money going into mental health, which seems like a third rail part of healthcare? That's interesting. Certainly, as I look back on the last, call it, year of venture announcements, they've been spare. There haven't been that many, but there have been plenty of those that have happened that have been putting money into mental health. So I think there's a couple of things going on there, and I don't quite understand, Brad, why you're calling it a third rail part of healthcare. But one is that younger people just are bigger consumers of mental health. So as the pig moves through the python, we're seeing more mental health demanded, more mental health provided. So that's one issue. There's lots of room for innovation. If you think of the old model of mental health, it was like drive to a clinic during work hours, park, go in. Maybe you don't want people at work to know you're leaving. Maybe you don't want people to see you parking outside of a mental health clinic, and then have a 45-minute conversation. That was part of mental health. Young people don't see their healthcare happening that way. There's a lot of room for innovation, and then also employers are having to deal with this. They need this kind of benefit. Employers always want lots of young people working at their firm. And so to get those young people to attract them and to get them to stay, they need innovative mental health benefits. So that's what I see, and I'm not quite sure why you mean it's a third rail. Sam, any thoughts on that?
Yeah, I mean, I think we're still in a mental health crisis in the United States based off of supply imbalances and demand, and education about the importance of education and acceptance of mental health in a way that's fundamentally different than it was a couple decades ago. I think the other thing is, if you talk to any payer exec, if you spoke to someone 5 or 6 years ago, you said, what's the most important thing for you to figure out and solve? And they said mental health. And if you talk to them today, I'd say, what's the most important thing for you to solve and figure out? And they say mental health. So in terms of why dollars continue to get invested here, it's still a huge problem for the people who pay for healthcare. And it's a huge patient problem. I think where we've seen more dollars continue to flow into is the higher acuity side of mental health as well. So the first batch of sort of V1 was lower acuity, expand access, and now really focused on how do you get access, or how do people get access to mental health services in higher acuity situations, which is a large and complex problem to solve.
Great, thanks. And we have Ubaid asks a question: beyond financial returns, what broader societal or healthcare system benefits can healthcare ventures generate? I think most broadly, Ubaid, I would say that venture investing in healthcare technology, it puts the intelligence into the products. The product could be software or a medical device or something else like that. And that fundamentally, it allows difficult problems to be solved more easily in more distributed environments at a lower cost by providers with lower skill at a lower cost for a greater number of patients. So that's the fundamental benefit. Is you take something, like we used to have open heart cardiovascular surgery performed by the highest level of cardiologists. Now we use stents. The intelligence is baked into the stent product, and we use a lower trained cardiologist to do that, and more people can benefit from that. So I think that's the broader benefit. Sam, any thoughts on that question?
Yeah, I mean, I think there's financial returns, but at the end of the day, it's about improving patient experience and outcomes, improving the well-being of providers and making it easier for them to do their jobs, and just providing broader health equity across an entire population. So every business we're investing in on the healthcare side at the end of the day touches either all of those things, if you believe they're going to get really large, or focuses on one or two of those at its core.
So now we're going to move on to the next section, which is reviewing upcoming conferences. What conferences are we going to? What are the good conferences to go to? Who goes to these conferences, and what do they get out of them? And for our audience, if you have any questions about conferences, want us to give a mini review of conferences, feel free to throw that in the chat. So the first I'll mention is an interesting conference coming up that I've been to in the past, the Health Innovation Congress, May 29th to 31st in Washington, D.C. This is a conference that brings together a lot of employers who are buyers of employer health tech products and a lot of providers who are buyers of provider tech products, with a view to evaluating products and buying products. So this is an interesting and a great conference to go to if you're in those two sectors and want to meet buyers and show off your product to buyers. And it's run by Cambridge Health Tech Institute, which is kind of a friend of the podcast, and they are offering our audience, so tickets are $3,000. They're offering our audience a 50% discount with the promo code Wardell, my last name. So that's the Health Innovation Congress in May 29th to 31st in Washington, D.C. And then another conference by the same company, Digital Healthcare Innovation Summit East, June 5th to 6th in Boston. This conference has been around for a while. This is the largest and best independent investor conference in digital health. Investor conferences are usually sponsored by investment banks and are for the investment bank's clients. This is an independent investor conference, so I've liked it for years, and they bring a lot of the VCs together. So for young companies that want to meet East Coast VCs, this is a conference to go to. Go to the conference, and then write to VCs in Boston, to digital health VCs in Boston and New York, and just say, let's meet at this conference. And a good number of them will be going, and it'll be convenient to meet with them at the conference or before or after the conference. So this is one that I like. And again, this conference production company has given my audience a discount code. So this is DHIS Social 1524, DHIS Social 1524. That's for a discount of 15% off the tickets. The tickets are like $1,500 for the tickets for that. So if I were raising money, I would put that on my calendar. I'd try to use that as a forcing factor to meet with the VCs. I'll be at the conference. I'll be meeting with VCs. Can I meet with, will you be there? Can I meet with you? Or can I meet with you in Boston otherwise? So both of these conferences I like. So Sam, any thoughts on these two conferences?
Yeah, I was actually supposed to speak at a panel in the second one, but we have our team off site, so this year I can't make it. I haven't been to the other one in DC, but I do find that any conference that is very focused on a couple specific audiences is where you're going to get the highest amount of value. So whether it's investors, whether it's customers, I know we chatted about Stephen. Some of what we see a lot with our portfolio companies is they're actually going to a lot of small regional conferences as well from a BD perspective and get a ton of value out of it. So we are big supporters and believers in, especially in healthcare, about how valuable that can be.
Yeah, thanks. And Alex points out that the Healthcare Innovation Congress, THINC, that it's a acronym for think. So the Healthcare Innovation Congress, its nickname is Think. And then also, so the next conference is there's AHIP coming up. So AHIP stands for America's Health Insurance Plans. This is the biggest industry association of health insurance plans. They're having their annual meeting June 11th to 13th in Las Vegas. Vendor tickets are $1,300. So this is if you sell to payers, you should go to this conference. You should also go to regional conferences like this, but you should go to the national conference. So AHIP is great. You can still meet health plan managers casually in the hallways, at lunch at AHIP. You should have an expo booth at AHIP. You'll see your competition vendors have expo booths at AHIP. So some conferences like HIMSS, it's hard to meet a hospital CIO at HIMSS. They're just too busy. But at AHIP, you will meet the plan managers for health plans, the other people in their office. They're going there for product education. And I would try to present at AHIP, but they usually make you get a health plan member sponsor your presentation because they bought your product and it worked for them at AHIP. But so if you sell to health plans, this is a conference to go to. Any thoughts on AHIP, Sam?
I have not been to AHIP, but I do think it's the general trend of go where the buyers are and focus there. So both regional and national ones I think it's just good money spent. I think we actually have a bunch of businesses who try they don't get the booths. They don't do that. They just say in some cases, even with the really scrappy ones are early, I'm not even going to buy a ticket. I'm just going to show up in Vegas and be there from the 11th to the 13th. get invited to different things because, of course, there's lots of other stuff going around. So depends on the stage of your business.
Yep. And
I do that sometimes personally for conferences. I'll be like, I'm just going to show up. It's fine.
Yep. And then, so the next is Health Europe in Amsterdam. So almost everyone who goes to Health loves Health because the production value and the content is good at Health in October in Las Vegas. And it looks like Jonathan Weiner and his company behind Health are now doing one in Europe. So who's going to the Health Europe conference? It's June 17th to 20th. So for startups, tickets are 900 euros. For general attendees, they're 2.2 thousand euros. So this is interesting for my American audience. I think the reason you go to Health in America is to meet with investors. It doesn't call itself an investor conference, but it's effectively an investor conference. But you'll see innovation executives from consolidators, but you won't see as many senior executives as you would at JP Morgan, let's say. But you will see the whole ecosystem of venture capital and private equity at Health in Las Vegas. But for my American audience, I don't see the reason to go to Health Europe. But for a European audience, it would be good for education to make your own presentation at Health Europe, to meet with European investors. I haven't been to it yet. This may be the first year of it. But for my European audience, this may make sense to meet with European investors for expansion in Europe. But if you want to meet with American investors for expansion in America, then I'm guessing you'd want to go to Health in Las Vegas in October. So we'll see on Health Europe. It is a nice reason to go to Amsterdam in June. So Sam, any thoughts on Health Europe?
Yeah, I mean, we know Jonathan well. We're investors in Health. We just launched another conference business with him in the AI space. I think you're spot on in terms of they're building a conference, Health Europe, for a new audience. And so if you are either in Europe and building your business in Europe, or if you're thinking about expanding to Europe, I think it's a great one to go to.
Great. And I saw that. So Jonathan Weiner, after having done Money 2020, a hit conference in fintech, has now done Health and Vibe in the US, 2 hit conferences in the US. And now he just launched a new conference on AI. So amazing. And then you guys backed that. So, congrats on backing that. I think the AI one is very topical right now.
Yeah, we're very excited to work with him again. And I think we're obviously in very early days of AI.
So next, personal notices. So for the audience, the next show will be May 22nd at 4, and the topic is what's working in digital health. And our guest is Alexander Lennox Miller, who is the health tech analyst at CB Insights. And then for our Boston-based audience, I'm hosting one of my Boston Innovation Nights next week, Thursday, May 16th, 6 to 9 at the Liberty Hotel. We've got Ren Room, who's an investor at Boston Millennia Partners, which is a pharma tech fund, and he's speaking on the innovation that pharma needs. So that's my personal notices. Sam, any personal notices where you can connect with our audience?
I would just say any people who are thinking about starting businesses, have friends who are starting businesses, it's never too early. We're in the business of trying to meet really amazing, great people who are thinking about innovating and changing the world for the better. So feel free to just reach out directly, and would love to hear from you.
Great. And so, by the way, what do you think of of entrepreneurs who might say, I want to hold back from talking to VCs because I don't want to go when I don't have a lot. I want to go later when I have more. And I don't want to meet with them casually, and then 6 months later they think that my company's stale because they haven't seen a fundraise announcement, but I wasn't even raising money or something like that. Would you say that entrepreneurs should reach out to VCs to connect, on a non-deal, that they're not raising money, but they're just connecting to talk about the market or technological change or something? Or what do you think?
Yeah, I think it depends on the stage of the business. So if you've raised capital and doing that, that's obviously really different than if you're in the ideation phase. I think it's just about being transparent about where you are. So if Stephen, you reached out to me, you're starting a business, I'm exploring these three different areas. I would love to get your perspectives and thoughts on that. And this is why I believe there's a really great opportunity based off of something that I've done. We love having those conversations, and oftentimes then we come back and you say, "Hey, I've been working on this for 3 months," and I said no. This other thing I was working on was wrong, and these are the reasons why. But it led me to company B or idea B, and actually seeing that sort of thought process and iteration can be really great. It's a stylistic thing though as well. So some people say I only want to talk to people when I have it fully baked. So I don't think there's a right or wrong answer, but I spend a lot of my time talking to people who haven't left their jobs yet, who are thinking about what might be next, and I love that. I think it's great.
That's great, thank you. And so Ubaid asks a question: what are the typical exit pathways for healthcare ventures, and how do they differ from other industries? Well, so you can go public. That's the same as other industries. You can be acquired. I think there's actually more options to be acquired in healthcare than other sectors. And there's also recaps, which is when private equity buys out the existing investors. So you used the word exit. That usually refers to investors exiting from a company to be replaced by other investors, like in an IPO, they're replaced by retail investors, for example. So in healthcare, there's a myriad of buyers. There's B2B tech, so Oracle bought Cerner. There's HR tech. There's big tech. There's Google buying Fitbit. There's hospital chains buying tech. There's software companies that are large digital health companies making acquisitions, like Teladoc buying Livongo. There's payers, like Optum is a big consolidator in the payer space. So there's a myriad, and in fact, I'm actually doing a show on this called "Who Are the Consolidators" coming up in the future, where I talk about all the different sectors of healthcare and the consolidators in those sectors, and what are the categories of consolidators and who are in those categories and who's active now and that sort of thing. So, anything to add to that, Sam?
Yeah, I mean, it gets partially into, I think, the back half of the conversation. But if you look at healthcare and you look at liquidity from venture-backed businesses in the last decade plus, most of it has been through M&A. Most of it has come from some of these large consolidators. You actually haven't seen as many large businesses go public and maintain enterprise value. So I don't think there's a right or wrong way, but at least looking at the last couple of decades of healthcare, the majority of it has been through M&A activity.
So now we're moving on to our main topic, which is the venture model a bust in healthcare? What I thought I would kick this off and just by saying that the classic venture model that we're all familiar with, call it technology in Silicon Valley, is that there's a company and it's building a high margin product. So that would be a software product. Let's say software products are the best high margin products other than on patent legal drugs. And then it's also a scalable product. So every consumer could buy it, or every business could buy it. And then they raise a lot of venture dollars, and they raise a lot of venture dollars to build the high margin product. And then they raise a bunch more venture dollars to hire a large sales force, or have marketing budget. And then they scale their product rapidly. And in this phase, they can rapidly, and VCs want to get in before this happens, because if they do and the company has a hit product, then the value is big enough to earn that back, the large amount of capital that was put into the company at high returns. And enough of these fail that you need hits in order to make up for the failures and still give the overall fund a significant return. That's the classic model. And then we've seen a huge amount of money put into digital health since the global financial crisis, since 2009, and the Fed's policy of ZERP after the global financial crisis. And with these companies, there's a growing criticism that somehow healthcare products don't meet this standard, that they cost more to create, they cost too much to create. Products the sales cycle is longer, it takes too long to sell them. And then when you sell them, they don't scale as fast as a B2B does, for example. And so that's one definition of the classic model, and then the critique of it. And so at that, I thought I'd hand it over to you, Sam, for this thought of is the venture model a bust in healthcare for these or other reasons?
Yeah, and I think at the core, venture capital is not right for the majority of businesses in the US economy and the global economy. And it's really around the belief that you can use those dollars to grow in a very unprofitable way for many years, with the belief that you will be able to cross that chasm to profitability and build an immense amount of enterprise value in a very short period of time. I think when we look at the healthcare sector, we did some work 4 or 5 months ago, sort of trying to sit back and say, what has liquidity, which is ultimately how you define success in venture. You're returning monies to your LP, you're returning money to your LPs. What does that look like in healthcare? And we were also interested in sort of looking at like, how did it look like in different sectors, from a services perspective, from a software perspective, and then from a sort of pharma perspective, but not pharma on the therapeutics end, and more just selling into pharma. And what were the characteristics of those businesses? How much did they raise? Where does liquidity come from? I think if we distill, we looked at unicorns in particular. So we looked at about 100 unicorns that had been created over the last decade to sort of try to understand what this looked like. Some of the core takeaways were, one, there's actually really been not a ton of liquidity created in healthcare over the last decade plus. And although right now, if you talk to a venture investor, everyone says, I just want to invest in software businesses because it fits more of that traditional venture model of high gross margin, high scalability. Most of the liquidity has been created in venture through services businesses. So tech-enabled service companies and things like that. And those businesses then getting bought by these large consolidators. If you look at the market right now, there's a question around whether that continues to be true. There's an immense amount of value sort of locked up in these private companies. And there's a question around, will that same trend hold true, where it's actually these services businesses that need to get to a much larger scale than $100 million of ARR, which is often this threshold that people think about on a software side. If you can grow and scale, become profitable, there are a lot of buyers who are excited to do that in the broader healthcare market. It'll be curious to see whether we have the same sort of reality over the next decade. But a lot of the work sort of led us to sit back and say, should we actually be thinking about backing more services businesses? But is the traditional model of you're going to raise 18 to 24 months of capital to do that right when you think about going out and funding those companies? There's a lot of additional takeaways in terms of somehow these companies were formed, but I'll pause for a moment.
So thank you. And for our audience, feel free to ask any questions here. And George raises an interesting question or points out that that the term tech-enabled services in healthcare is like a new term for digital health. And I'll just mention, so when I was on Wall Street, it was my job to define these things. And so I liked the Rock Health definition of digital health. Rock Health said digital health is technology in healthcare except services. So if you were HCA, you were not digital health. But if you were a software company selling an EMR to HCA, then you were digital health. And so they left services out of digital health. But it turns out that there are opportunities in services. Healthcare services is enormous in America, and it often is resistant to change and technology. It's a bad buyer of technology. It's a bad implementer of technology. It's a bad user of technology. And so there's an opportunity to start from scratch and have I call this the black turtlenecks trying to eat the lunch of the white coats, and start from scratch. So with One Medical, you had a national branded medical practice started. And why had doctors not started that practice before it was started by technologists? Yes, one of the founders was also an MD, but they were coming at it from a technology angle. So doctors just seemed to be poorly suited to build a national technologically led medical practice. But technologists from Silicon Valley seemed well suited to build that. So the example I like to use is Uber. So Uber doesn't own any cars, but they sell taxi rides. They don't sell logistics software. They sell taxi rides. And so Uber kind of reinvented healthcare, but they provide services, and just like Teladoc's an equivalent in healthcare, and Teladoc provides care, not software, to their buyers. And so that's the difference. So intriguingly, I would say Teladoc is tech-enabled services in healthcare, whereas Cerner is digital health. So
yeah, I think today tech-enabled services all kind of get bucketed into one category. And One Medical is a very interesting example, right? Where you listen to that story and about how Tom Lee started that company, and it was, I'm going to come in and reimagine the software stack as a core part of them starting that company. The core care that was being delivered looks very similar. They weren't recreating primary care, but it's how it was delivered that was recreated. And then you look at businesses that have been, large, and a business like an Agilon or a Privia is really around saying, we are going to help a group of providers take a bunch of the administrative work off of their hands, and then also help them from a contracting perspective and do that. And they use a lot of technology that sits underneath that to also say, how do you ultimately want someone to deliver care so you can build a repeatable and scalable process when you're going and contracting with United in a market on the other side. So I think there's different flavors of it. I think it was interesting when we looked at a lot of the companies that ultimately have driven liquidity in the last decade. About 75% of them, though, were created through non-traditional venture structures. I.e., and I say non-traditional being they didn't go raise a seed or a pre-seed, a seed, a Series A, a Series B. A lot of them ended up saying they were incubated, or the businesses were formed in unique and different ways. So like Agilon is a great example of this. Even a business like Flatiron, which, they raised a seed round, but then they went and raised an $100 million round to buy an EHR. Is not a traditional financing structure. If you're not Zach and Nat, most people don't have the ability to go out and do that. And it's something we continue to think a lot about. And when you take a look, you go a little bit deeper into it. What's interesting is the realization that in a lot of cases in healthcare, the larger businesses that have been built are more about execution risk versus finding product market fit, which is sobering when you take a step back. But when you look at liquidity, most of it is around saying, this has worked somewhere else here. We're going to shift how something is delivered and rebrand it. And we're going to do it in a different part of the market. And that's going to create a lot of enterprise value. And we're going to be able to tell a different story around that. But in a lot of cases, it's not about taking huge product market risk, which is very different than a lot of other venture markets or other sectors in the world of venture.
So Alex mentions that services are very digital now. And Alex, I guess what I would point out here is that in healthcare, I think incumbents are often very resistant to change and are bad buyers, implementers, and users of technology. So there's actually like an unfair fight here, an interesting case where someone can come on board with a sort of a born digital services company, a born digital medical practice, a born digital pharmacy, and they can create a modern business with greater efficiency, perhaps appeal to consumers differently and better, and the incumbents will not immediately copy them. Whereas if we were talking about the gaming sector or the semiconductor sector, competitors are right on that stuff immediately. Within a year, making all the same claims you're making. But in healthcare, there's this intriguing opportunity that healthcare services is enormous, and the incumbents don't react and change or as quickly. So someone can come in as a technology-enabled services company and compete with incumbents, and they don't immediately change. And that has to do with it's a highly regulated industry, and that doctors have a unique role and often resist change, and so there's a lot of issues like that.
I think one of the challenges, or what you see, is that you are still selling into these same large incumbents on one side of it. So you might be taking on one incumbent. You may be saying, I'm going to deliver cardiovascular services different than, in a different way that gets access, gets me to a patient faster, provides a better experience, et cetera. But you still on the other side of that trade need to be able to go contract with a large payer to do that. So I think one of the challenges in healthcare, which is particularly acute, which is different than if you were selling software to plumbers, as an example, is that the sales cycles are really long, regardless of who you're selling into, and regardless of the product that you're building. So I think we think a lot about that, and that's a lot of that was some of the original question for us was like, is venture the right model for healthcare? I think our perspective is you can build really large, great businesses in healthcare using venture capital dollars, but you might want to think about giving yourself more runway to go out and do that, and giving yourself the time to, whether you're on the services side, prove you can deliver a high quality clinical service, give yourself enough time to show those results, and then be able to go out and raise capital, versus being on this very short timeline of you're starting from scratch and I need to go build a clinical team, acquire patients, deliver care to patients, demonstrate that the outcomes are better, and I need to do all of this incredibly quickly and then go raise more capital. And I think the same is true from a software perspective. I got to build a bunch of software. I need to deal with in whether 12 to 18 month sales cycles. I need to show that people are getting value out of it. So we think a lot about how do you capitalize businesses in the healthcare sector to give them the time to go out and to do that and get those proof points so they can go raise that next round of financing.
So speaking of the classic venture model, which is that you run a company that burns cash, that's cash flow negative, that's loss making for a long time, raise a lot of money to first build your complete product, then raise a bigger chunk of money to go sell your product, and then you're counting on high margins and rapid scaling. That's the classic model. So one way that we hear of these companies, of digital health companies failing in that, is that under the classic model, typically, let's say call it B2B, you raise money for the next 24 months. Both sides agree that's the right amount of time. And then your sales cycle is less than a year. This is in B2B. But then in digital health, the sales cycle can easily be more than a year. And suddenly you have no accomplishments after your 24 months of capital runs out to brag about. But it's much riskier to fund a company for 36 months or 48 months. And so it's a less attractive proposition. And we haven't quite figured that out. That's one of the big problems that digital companies have run into.
I think when you look at a lot of the businesses that have been incubated or have taken non-traditional venture paths, one of the core characteristics is that they raise more capital up front to give themselves the time to be able to weather those storms. Often what also comes with that is they hire teams that look more senior than a traditional early stage company would, to say, I have to go contract with United. And I need to hire the person who's done that beforehand, because I don't want to, I don't even want to, I can't afford to have someone on the payroll going through the trial and error that you often would in an early stage startup. So I think it's riskier to fund someone from 36 months, but at the end of the day, it's all around, it's a dilution and ownership question. And in some cases, what you see in these healthcare businesses, that you also see more interesting rounds where capital's being tranched. Not all the money's going to the business up front. It's saying, go out, prove X milestone on day one, and then you're going to, the money's here and you're going to unlock additional capital here. You can build and grow the business in a way that gives you the confidence to make those key hires and to invest in the right way up front.
So we have a question from Jonathan, which is there a risk in creating a SaaS product in a vacuum, I'm assuming this is in healthcare, as opposed to co-developing that solution with hospital providers and end users as partners and end users of it? So yeah, I would say so. And part of that risk is that I think healthcare is more tribal than, say, the Fortune 500, which is to say that if you, were to come up and were to be validated by the partner system and MGH, MGB in Boston, that would say a lot about you. And then there's a tribal group of other hospitals that look to Partners MGH as a lighthouse, and that buy their kind of medicine and will adopt that.
Mm-hmm.
And so if you come up in that system working with them with their endorsement, you could expect to sell to people who are part of that system. But likewise, there's people who, even within Boston, don't like Partners MGH. They like Beth Israel instead. And so you're not going to get their business. And so if you don't partner with somebody early, here we're talking about the provider world, you have a risk of nobody wanting to adopt you. And then if you do get into one tribe, you'll get a preferred adoption from that tribe, but possibly a kind of avoidance from other tribes as well. So it's a dilemma, but I think you have to partner with existing providers for validation and to be able to sell at an advantage within their tribe. So
yeah, I would say that that's not just a healthcare thing. We invest across every sector here at healthcare at Primary, and if you have a fintech product and you successfully sold into Bank of America as an early customer, that's a ton of validation as well. So I think you see this in a lot of any sector where there's large enterprise sales, you see this dynamic. I do think that, to answer the original question, you need to be working incredibly closely with your customer, regardless of who that customer is. And I think it's a classic mistake, and I've worked at businesses where we made this mistake personally, and we see this often in startups of, we know the problem, we understand this, we're a bunch of smart guys and gals in a room, and we're gonna, how the system works today is broken, so we're gonna go into the back room and fix it, and not be interacting with the customer or the potential customer in a very frequent way, and that is a recipe for disaster. I think you need to be working and co-developing, and it doesn't mean it has to be a formal thing. It could be your design and discovery partner. You're someone who I'm just going to be getting feedback from in a frequent way, but it's something that is a must for, I think, every early stage company if you're building any sort of software.
So Bartley asks, do you consider health payers, such as insurance companies, to be part of the health sector? So yes, I'd say the term, to me, healthcare services, which is an enormous part of the economy, that means payers and providers. And there's two kinds of payers, or three. One is commercial payers. The second is employers. Employers are a kind of payer. And the third is the government. So yes, together, that's healthcare services. And that's usually, we think of them as three parts because we minimize the government's role here. But it's provider organizations, payers, health insurance payers, and then employers as a payer when they're self-insured. Mm-hmm. And then there's two sort of less well-known parts as well, which is consumer digital health. That's like people buying Fitbits with their own dollars. And then there's pharma tech, which is companies like Viva that sells sales automation and document management automation into pharma, or Medidata, which sells clinical trial automation into pharma and life science. So I do consider that to be at the heart of healthcare services. So I wanted to sort of summarize what we've been saying. So the classic, every once in a while you hear of a digital health software company that knocks the ball out of the park. That's great. We want that. We want to see that. And we want the change that brings and the value that brings to patients and providers in the healthcare system. But we also see problems of young companies that were given 24 months, a runway, having little to show at the end of 24 months because things just work slower, or that it took them longer and they had to raise more money, and this is killing the ROI that everyone expected to get from this company. And so some of the solutions we're talking about to that, one is tech-enabled services. One of the advantages of tech-enabled services, two advantages. The first is it's possible to become profitable quite quickly with services. So you don't need to raise the vast amount of money that you do with a software product, which has to be built and sold before there's a chance of making a return. So with services, you could become profitable quite quickly. That's the first. The second is there's this intriguing opportunity that the incumbents don't fight back, or the incumbents you arrive with more automation, more customer friendly, and then the incumbents don't just copy you, and they can't just copy you for years. So that's an intriguing opportunity there to have higher margins for a longer time in tech-enabled services. Second, we talked about was incubating longer, and then we also, so that you're in an incubation stage when you work out issues like how you're going to sell, for example, and you're not on a venture dollar time frame when you have to work those out. And then another one we talked about was hiring more senior executives, which then usually is harder to do and costs more, and just means there's going to be less innovation if it's more expensive to do innovation. Any other thoughts as to if the classic venture model has these problems in healthcare, how people are addressing that?
Yeah, I mean, I think if we take a step back and just think about the healthcare market, our perspective is healthcare is too large and too broken and has too many tailwinds right now to not adopt technology over the next decade in a way that's fundamentally different than they have for the 10 years prior. You think about labor shortages, rising administrative costs, reimbursement, like there's so many different things where there's a lot of challenges to run any organization in healthcare. I think the real bull case is on top of that is that although healthcare has been slow to adopt technology, the data and sort of digital foundation has been laid. And people today are a lot more familiar with software, and also really the HITECH Act in a lot of ways laid the groundwork for clinical organizations to start to structure and use that data. So I think there's a lot of reasons to be excited from a pure play software side of healthcare. I think there's still questions around how much time do you need to be able to go and still prove out success. So we are very bullish. Generally speaking, if I wasn't very bullish, I probably wouldn't be doing this job. Is the honest answer. And then I think the other piece, Stephen, that you mentioned is I think even though tech-enabled services has been a bit of a dirty word in the venture market for the last year plus, our perspective is that there are real opportunities to build large, meaningful businesses that have an immense amount of enterprise value. You just have to be creative in terms of how you make sure those businesses have enough time to prove the things that they need to prove before you have to go raise more venture capital dollars. Because once you raise VC dollars, you are on the hamster wheel of needing to raise more capital at some point, most of the time, because you're building and growing a business in a way that is different than if you and I were just saying we're going to go start a company with the money out of our bank accounts. So I think there's a lot of reasons to be excited, but a lot of work to be done over the next decade.
So Liz asks if you do, and by the way, you mentioned kind of incubating before raising venture capital dollars. So I think very interestingly, there's a role for incumbents here, which is you could incubate, and then what if you were to incubate at J&J? What if you incubate, at HCA? And then there's also incubating at venture funds. We talked about how earlier in the show, we talked about how a cybersecurity company focused on hospitals incubated out of GC Hat, for example. So this ability to have more time and then dollars that don't count as venture dollars with a clock associated with them to work things out. It's also a lower risk, lower pressure, lower profile role as an entrepreneur. You sort of go into incubation mode and have a lot of failures before you show up with a success a year later and look like a genius. But you didn't fall flat on your face in front of everybody, and waste $10 million or something. But I think it's intriguing to think of more innovation happening at large companies. We know structures that allow large companies are often seen as bad at doing this, but there are structures that allow them. I think they're getting long-term smarter over time. For example, you wouldn't, if incumbent incubated companies, they would have to give them the right to go after the whole market and not prevent them from pursuing markets or prevent them from partnering with other people. That tends to wreck the company's viability in the future. And I think the industry's learned that over time. So Liz asks the question: if you don't think VC is a great fit for venture stage building value in healthcare, what is the different capital you're providing? A venture studio structure or something else that gives a runway?
I think venture can work in healthcare. I think you just have people need to go into it eyes wide open around what are the milestones and things that you need to prove. And that's going to depend on the type of business you're running. And you might say you want to capitalize the business differently based off of that. I think if you look at other private markets, like private equity has invested an immense amount of dollars into the healthcare market, but it's a much later stage game as you think about that. So I do think venture can work in healthcare. I just think it's important for everyone to be eyes wide open around what are the expectations, and it may be based off of long sales cycles, regulatory environments, challenges there. You can't iterate and sell and move as quickly as you can in other markets. So it's more around people aligning their understandings of what might be needed.
So an entrepreneur who was doing a fundraise might have been raising $20 million for 24 months in the past, and now he's going to have to raise $30 million for 36 months in the future to be more realistic. But then that's might be a tougher deal to get done.
It's just a question of how much you're going to sell of the business and how much risk someone's going to be willing to take in that. And that's a bit of there's always a balancing act and too much capital is not necessarily the right thing as well. We've certainly seen examples of you have too much money on the balance sheet and that leads to not being forced to work in a constrained way, and that can lead to its own challenges. So unfortunately, there's not like a magic wand of saying this is exactly the right way to do it. I think there is nuance to it. But I do think in the earlier stages, people need to be willing to think more creatively than perhaps they have in the past. And the data over the last 10 to 15 years proves that most of the dollars created and liquidity created were by people who did that. who said, we are going to form a business in a different way and get access to capital in a different way.
And George mentions that he's seeing a growing number of VCs, including General Catalyst and A16Z, incubating their own companies versus investing in new founders. So yeah, that could be an outcome of the end of the ZERP era. Might be a trend we see.
And most of these funds have been, I mean, we've been incubating businesses since 2016. A lot of these funds who do it have been doing it in a meaningful way. And I think there's more people starting to think about it today. It's incubating business is still hard. Like, it's company formation. So it is not an easy thing to go out and do. And I think there's lots of examples of people perhaps going too far in one direction as well on the incubation side.
And for our audience, now's the time to ask any final questions for Sam. And then, so Sam, we were hearing some chatter about the B2B world in Silicon Valley. And in this world, it's sort of a fruition of the thesis of this show, which was, is the venture model a bust in healthcare? But it was for B2B specifically because of high valuations. And the story was that of B2B businesses that got funded with large rounds of funding at high valuations during the height of the bubble, which would have been 2020, 2021, that time frame, that many of those companies are going to sort of fail their plan, their financial plan, which is going to be a real setback operationally for the company. And many of the funds that funded them are going to have sort of wrecked vintages because of this. So that's sort of a lot of this stuff is very private. It's hard to know on the outside. Insiders don't talk about it. But do you think that's happening in B2B in Silicon Valley? And do you think that's happening in digital health for funds that invest in a lot?
It's happening. Yeah, it's happening across the entire venture industry. The 2020 and 21 vintages are going to be horrible for a lot of people because they invested at the highest prices and have businesses that are going to be really challenged to get back to where those prices are. The venture model is all about outliers, though. So you'll have some people who got it right. But I think if you looked at the asset class as a whole and said, was that the best vintage to invest in versus investing, an earlier vintage or even the current vintage? My guess is, as an industry, you are going to see not as great of returns in some of those vintages.
So one last question. We were talking about a new kind of funding. And so Bartley asks, SAFE have been used for some time in the West Coast. What level of adoption has there been in other areas of the US? So my take on SAFEs is they're a great innovation, but they're part of venture capital. They're not an alternative to that. They're not some alternative that has a longer time frame or something like that. Sam, your thoughts?
Safes are super widely used, and I think every VC uses safes, especially in these early rounds and doing it. So yeah, it's a very common thing.
That's great. Well, so with that, we've run out of time. Sam, thank you so much, and
thank you
for joining the show.
It's great to be here.
And you've been listening to Digital Health Investor Talk with your host, Steve Wardell, and special thanks to our guest, Sam Toole. We're publishing this show as an episode of the Digital Health Podcast. Subscribe to our podcast on Apple and Spotify. Make sure you're visiting the new pages to subscribe, because the old pages for the show are not getting updated. Don't forget to rate us. We would love a 5-star review. Our next Digital Health Investor Talk show is Wednesday, May 22nd. The topic is What's Working in Digital Health with Alexander Lennox Miller from CB Insights. And we're looking forward to see you there. Thanks, everyone, and until next time. Bye-bye.
Thanks all.